The TSX Real Estate Index lagged the TSX Composite in 2024 by more than 16%. But as the Bank of Canada continues to lower interest rates, the outlook for REITs appears to be improving. Our next guest expects Canadian REITs to generate 10% in total returns this year, roughly. Dennis Mitchell is CEO and Chief Investment Officer at Starlight Capital. Dennis, great to see you. We haven't done this for a while.
Good to see you too, Mark.
Yeah, so 10% total return on average. What would be the catalyst to drive that in 25?
Right, and I actually said 10% plus. And I always keep sort of total returns going forward. I always break it down into the three buckets, right? So what kind of growth are you going to generate? What kind of multiple expansion can you expect? And what kind of yield do you pay? So superimposing that on the Canadian REIT sector, you're looking at about 4% sector growth in terms of earnings. You're at about a 5% tax efficient distribution yield. So just putting those two together, you're at about 9%. And then the entire sector is trading at a 17% discount to net asset value. And net asset values are rising based on interest rates coming down, so cap rates coming down, and net operating income growing. So when you put all of those together, you're comfortably above 10%, probably closer to mid-teens in terms of a total return. And your question about catalyst, it really is about the long bond yield. The more we see the Bank of Canada cut the short end of the yield curve, that is great. But what we need to see is inflation expectations come down a little bit. Long bond yields come down. That'll be the catalyst for capital moving into the sector and correcting that discount to net asset value.
So you foresee the Bank of Canada cutting by as many as 125 basis points this year, which I believe would bring the key rate down to 2% or so. But as you mentioned, those long bond yields need to cooperate. So what is your concern about inflation remaining sticky?
Yeah, it's not so much that inflation is remaining sticky. I think the big issues right now are sort of the tariff discussion around Trump. I think what you're seeing is, tariffs and some of the other programs that Trump would like to roll out in terms of continuing to cut taxes, increasing military spending, engaging in a tariff war with China, Mexico, Canada, and pretty much everybody else. All of those would be inflationary for the United States. And as they are our largest trading partner, and he's talked about a lot of things, but he's talked about imposing tariffs across the board on Canadian imports. All of that would be inflationary, not just for the United States economy, but for the Canadian economy too. And so what you're seeing right now is long bond yields in North America responding to that threat and remaining stubbornly high. So if we can come to some agreement where we're not going to see 25% tariffs across the board in Canada, then I think you'll see long bond yields come in, and I think you'll see Canadian REITs rally as a result.
You might have heard that U.S. President-elect Trump said he is not going to invade Canada militarily. So that's a relief, right? That's off the table. Thank goodness for that.
That didn't factor into our valuation models, Mark, but yeah. We'll think about that for the second half of next year.
Okay, very good. Let's get to some names here. Primaris is a shopping center REIT, and I'm sure many people straight off the hop would say, oh, shopping centers, they're dying. But why does this one stand out?
Right. So first off, shopping centers aren't dying. There certainly isn't significant incremental demand for more malls per se, but the existing malls have sort of hit an equilibrium in terms of foot traffic and demand. So what we like about Primaris is it's the only mall-focused REIT in Canada. It's primarily B malls and secondary and tertiary locations, although they do have the odd asset in, say, Toronto and the GTA. What we like about this REIT is it's got a great management team. Alex Avery, former CIBC analyst, Regs DeVloer, former RioCan CFO. So experienced management team that the street knows very well. It's trading at a massive 23% discount to net asset value. And what's interesting is that this NAV is growing by about 7% this year. And that, again, is just a function of internal cash flow growth driven by leasing. It's yielding over 5%, but it's got a very attractive payout ratio of about 77%, so there's room for that distribution to grow. The leverage is relatively low at 5.7 times net debt to EBITDA, and occupancy at 93.5% means there's some upside from leasing in terms of occupancy as well. So we like the valuation, we like the team, we like the opportunity set, we like the uniqueness of the REIT, so we'd be buyers of this name at these levels. And in fact, we do own it in our portfolio right now.
Another name out of the U.S. is Prologis. I know that you've liked this for a long time and likely have held it for a long time. We had a guest earlier today, Dennis, saying that this really is a bellwether in the sector, and beyond that, maybe one of the best managed companies in the United States. They have Amazon as a big client. So run down the list of the factors that you like about Prologis.
Right. So Prologis is the largest industrial REIT in the world. They've got about 1 billion square feet across 19 countries, including Canada. But an interesting, and they've got growth potential through just about every lever: acquisitions, releasing. And to put it in context, just about 10% of their portfolio is going to come up for renewal this year, and rents are going to be marked up about 60%. So that gives you an idea of the internal growth that they can generate. But on top of that, a newer business that they've started is redeveloping warehouses into data centers. So they did one asset that they took one warehouse and they redeveloped it into a 32 megawatt data center, which is a fairly large asset. And they sold it to an Australian investment firm. We estimate that it cost them about $400 million to develop the asset, and they sold it for $735 million. So an enormous ROI. There's probably about 100 plus of these conversions they can do over the next 5 years. So you know, if we're gonna generate ROIs of 20 some odd percent, redeveloping these warehouses into data centers, and we can do that 100 times over the next 5 years, that's just another lever of significant growth that Prologis can roll out. So it's trading at about a 16% discount to NAV, and obviously the NAV is growing. So it's a name that we like. We own it in the portfolio. It's one of our larger positions. We'll continue to own it.
And then from a demographic standpoint, you like Chartwell. If you could just give it a slightly shorter answer here, and then we'll take a break and come back with you for more.
Sure. Largest seniors housing REIT in Canada. Full disclosure, we own it in the portfolio, and my daughter works there. You know, there's about a demand for 200,000 seniors beds between 2025 and 2042, and we've only built less than 72,000 in the last decade. So occupancies are going to continue to be pressured up. Rents are going to continue to climb, and this is a name that's positioned perfectly within the sector to do significantly well going forward. So we own it in the portfolio, and we'll continue to add to it at these levels.